Tushar Pradhan of HSBC Asset Management joins us right now on the show with his thoughts. Tushar, good having you. It's been a while. Thanks so much for joining in. What's been your central thesis? This weakness more so versus the global markets too, and within the Indian markets too. I mean, quality versus non-quality. Does this weakness last, or do you reckon that at some point of time we'll start seeing some definitive buying into the Indian markets?
Yeah, I think it's a combination of factors. It is not one thing that we can assign it to say that this is the reason. There has been a fair bit of uncertainty globally. There has been a geopolitical situation which has just developed very recently. There is the general under-delivery of earnings, especially in some sectors within our economy. All of that is leading to a situation where we don't really feel confident about entering, because who knows how long this could continue as in the weakness. So one of the things we have to understand is that asset managers clearly invest throughout the cycle. So for us, it's not always a good or a bad time. It is always a good time. But I think from an investor's perspective, most of the bad news, whatever has come out, probably is out there. There may be some unknowns that we yet have to come across. But I think overall, if you look at the general negativity around, I think more or less most of the prices do incorporate that. Has it gone beyond fair value into very deep value? I still don't think so. I think there are some pockets where the valuations continue to be pretty demanding. But I think on the average, I think one should believe that most of the negative news is already in the price.
Interesting. Actually, somebody made this interesting point yesterday, Tushar, that while we scan the broader markets as well, and the index will obviously show a low because the index is filled with a clutch of really bad companies too. But the quality names in the BSE 500 too, the ones which have delivered earnings, don't have balance sheet issues, are still trading at very premium valuations, in some cases even more premium than the Nifty 50, select set of Nifty 50 names. So wherever there is visibility or lack of quality issues, the pricing is still high. So what does anybody go out and buy?
Yeah, so that's a classic conundrum, right? So every time that you see quality, it really gets overpriced. And wherever there is any doubt that things could get worse or they are really not really hunky-dory, people bash down the price. So investing is all about finding value. And it is not about good companies per se. It is a good company at a reasonable price, or a very, very good company which used to trade at very premium prices coming to reasonable price, or a company which really doesn't have that much of hope but trading at such a low price that it is worth even less than what you can break it up from. So I think investment success has got to do a lot with our perception of where the value lies. So there is no one size fit all kind of answer to say, well, what does one buy? One does buy things where one perceives value. So when you talk about overvaluation compared to what? Its own history and its potential, maybe then that's not that much overvaluation. But compared to, say, maybe other companies which are struggling and as a result they are much lesser value, then relatively overpriced. So I think we have to readjust our view in terms of where the relative value emerges. And in that case, I think the opportunities are completely open. One can fish in the waters where things are really murky and the opportunity is not really very visible. So one can take a chance there and to see whether the conviction in terms of any one story turning around is stronger, and you will make a lot of money along that way. A slightly more riskier approach, but there could be other approaches where you can say from relatively easy valuations it's going to go to premium, or from premium it might go to super premium. So that's how you make money. So in a sense, I would think that one shouldn't really wait for this simple standard metric of value and say, well, this is overvalued and that is undervalued. So I would think that investing is a lot more complicated than what most people make it out to be. But I think there is plenty of opportunity across the spectrum at the moment.
Tushar, good morning. Devina here. And, just like you said, the classic example of where people perceive a lot of value and where the valuations are very stretched is the consumption-oriented names. And like you highlighted, for certain stocks, premium can go to super premium, depending upon the kind of value people perceive that stock to have in that particular space. Do you see that happening for consumption?
Well, in consumption, what typically tends to happen is when you have an economic down cycle, say for example, when the economic activity is not picking up, or in this case, as I could think of, in India, I think people are all waiting for a little while to get more clarity on the political landscape before putting some hard money down on capital expenditure. When this kind of period extends, the money tends to move to more visible earnings and consumption as a result, which is a given in such states, and these prices then tend to get overbid, and that is the slight overvaluation that you will see along the way. When the cycle turns, however, you will find that some of these consumption companies will start to come down, not really in price, but the valuations will clearly now reflect a lot more average valuation for the sector than what is currently now. So right now you see the problem, what is we call as an opportunity cost of capital, where because one tends not to invest in the more cyclically, industrially, metals oriented companies, the premium goes to companies which don't have these cyclical issues, and they are preferred safe harbors so far as the current situation is concerned. But the safe harbor will evaporate dramatically if the economy turns around. So the risk of being in these consumption companies, which are at the moment fairly above average price multiple, the risk always remains that the economy picks up, and then making the move back into the cyclicals might be a tad difficult to do. So I think we advocate a situation where we diversify across and try to have a little bit of a share across the entire economy, so that once it starts moving, you have a share in the pie.
Just that while these are your views on consumption, the interim budget left a lot more money in the hands of the middle class, which obviously is not that much more money, where consumer discretionaries will see a big benefit, but definitely consumer staples will see that spending trickle in. So in light of that, even if they're marginally more expensive, the prospects look that much more sanguine.
Yeah, I think I would tend to agree with that thesis. However, you have to understand that penetration of staples in this country is fairly high. So, it is going to be the marginal adopter of staples as a normal consumption item who was not having standard, staple consumption. You also have to remember there is a very large unorganized sector, which is not any of the listed companies which provide staples. So if you go down to the second tier, third tier, even rural towns, you will find that the FMCG products that you get are not from the top 3 or the top 4 companies in this country. They are actually similar products, but they are manufactured locally. So what I'm talking about is this kind of incremental expenditure which they may be able to do may not necessarily affect the overall picture as we see in the larger listed consumption companies. But I think the sentiment clearly will improve. So I think the reality will be between what I described as being completely off market to the current market perception that everything will go to the listed companies. I think the reality is somewhere in between.
What is it that is the biggest risk, Tushar, to this next 6 months? Is it domestic factors like the election and the volatility thereof? Or could it be something that comes from the global side, if indeed this trade talks break down and US and China take harsh measures against each other? Is that a bigger risk?
I think the global rhetoric clearly from whether you talk about the Federal Reserve in the US, or if you talk at the level where the economic outcomes are measured by way of expectation of economic growth, I think all of that is softening. We also see a little bit of a dovish commentary coming from the US when it comes to monetary policy as well. So I think the overall situation may not be that harsh from a global perspective. I think people are bracing for a little bit of a slowdown. So I think monetary situations will adjust to ensure that there is not that much of a risk from that. In fact, a little bit of a risk on is pretty much available today across asset markets. I think locally there is a lot more uncertainty. I won't call it risk per se, but there is a lot of uncertainty regarding the outcome of, first of all, the election and the economic manifesto post that. Secondly, of course, the unknowns remain about the outcome of the net NPA situation with the banking sector and where that gets resolved eventually. The logjam in the infrastructure spend and generally the lack of capex across the country. So I think these are pretty obvious factors which I think we need to keep a track on. And that will only change when the confidence comes back. So it's not as if the money is not available. The capital in today's world is pretty much available for somebody to want to invest. But the environment has to be set right. The environment currently is uncertain. And I think it will take about 6 to 8 months before the uncertainty goes away to kind of get the confidence back into investing. So I would think that the next few months could be more volatile. There could be a lot of change in terms of how people perceive the investment climate to be. But I think as it eases off towards the end of the year, clarity should emerge.
Okay, let's wait and watch if that happens or no. My final question to you, Tushar, would be about your assessment of, as a buy-side person, about when do you guys reckon we could see some meaningful earnings growth which is not marred by very large one-offs? Because thus far, you can argue that 2019 has been slightly different in that the broad basket looks okay, but there are some large one-offs which are hampering the growth. Does that change meaningfully going ahead?
Yeah, because the very nature of the one-off is that it is a one-off. So I would think that the momentum, if it continues the way that we've seen in some of the broader market earnings numbers, then eventually the one-offs will also, on a YOY basis, clear itself out within a year's time. And I think we should see a very strong earnings number coming forward. I think all of that seems to be in the price, as a result of which the headline stock markets are not appearing to be cheap. So which means this is already incorporated in the price at the moment. Where the value, of course, is off index, where the earnings growth continues to sustain, but the prices are not moving. And that, I think, is something to do with what I talked about, is about investor confidence. Even if the value is available, most people are not willing to bet on it because they fear that they either not be able to sustain those earnings growth rates, or the fact that the economy is still a little uncertain in what direction it will go. So I think the earnings are pretty much there for everyone to see. I think it's about confidence. And I think the confidence will only come once all of these uncertainties are behind us.
All right. Tushar, it was a pleasure chatting with you. Thank you so very much for joining us this morning on the platform. Hope to see you more often.